sorts of tea about what's going on inside Washington, D.C., what regulators and lawmakers are working on and thinking about, and how you and your institution should be evaluating potential risk areas and areas of opportunity. My name is Ann Petros, Vice President of Regulatory Affairs at NAFCU, and today I am joined by Todd Zywicki, who is Professor of Law at the George Mason University Antonin Scalia Law School, and a research fellow of the Law and Economics Center and former chair of the CFPB's Task Force on Federal Consumer Financial Law. And Todd is an expert on consumer credit and lending and consumer protection law. So today we will be discussing interchange and recently proposed legislation on that topic, the Credit Card Competition Act. So thank you, Todd, for joining me today.
Thanks, Ann. Great to be here.
All right. Well, let's jump into this interesting topic and something that our members have been really fired up about because we've all seen the impacts of the Durbin Amendment to the Dodd-Frank Act. So, could you just briefly walk us through the history of the interchange issue, starting with a passage of the Durbin Amendment, and why was this a concern to begin with, and why have merchants been so effective in their messaging on this issue?
Yeah, so like a typical professor, you said to start with the Durbin Amendment, but I'll start before the Durbin Amendment, as we are wont to do. Basically, in the run-up to the Durbin Amendment, there had been a lot of discussion about regulating interchange fees. The merchants had been really pushing to do that, just basically because they didn't want to pay for interchange fees, right? And this really came back to the idea of the great growth in debit cards beginning in the 2000s as checks got phased out and debit cards got phased in. Obviously, that was good for merchants to not have to deal with bounce checks and the time of checks. But the difference is that that checks cleared at par, and they basically had to pay for receiving debit cards, which they didn't really want to do. And so prior to the Durbin Amendment, the idea would have been to do very limited interventions in the market, for example, allowing merchants to collectively negotiate interchange fees and that sort of thing. And out of the blue, in a midnight amendment to Dodd-Frank, Senator Durbin came forward with this idea of price controls on debit cards. And originally, I think it was going to be $1 billion, and that covered too many banks. So they just made it up on the fly and made it $10 billion. And the original Durbin Amendment did two things, which is first, it imposed price controls on debit cards, which you can come back to. Second thing was a provision involving routing of debit card transactions that required at least two unaffiliated networks on the same card. The Durbin Amendment price controls dealt with only banks above a certain size, 10 billion. The multiple routing requirements covered any transaction. So the deal at the time that was promised, of course, to people like your members was, well, this won't affect you. We're just going after the big banks, right? The Citibanks and the Chases and those guys. As I think all your members probably know, that turned out not to be the case. But what it did do over time was it reduced debit card fees overall. At the time, it had been promised in some sense this would be passed on to consumers in lower retail prices, which has not happened. And we could come back to the evidence on that. But this has turned out to be a really big windfall for the for merchants, especially the big merchants, the Walmarts, the Amazons, all these, the big box retailers who've made a huge amount of money off of this and haven't passed it on in any noticeable way. And now they're back for more, which is they want to take the ideas of the Durbin Amendment and extend it to credit cards, which were left untouched as part of the original Durbin Amendment.
And why is this appealing to lawmakers? What's the impetus to evaluate this on the credit card side?
Yeah, and so what's interesting about it is if you look back at the debates of the original Durbin Amendment, the reason it was applied to debit cards and not credit cards was because they recognized at the time there's credit risk. And to some extent, what they just decided is kind of typical Washington thinking, which is it was easier to basically engage in central planning and price controls of debit cards than of credit cards. So they said, we'll just apply it to debit cards, right? But they recognized at the time that credit cards have costs associated with them, notably credit risk that debit cards don't have. And so to try to micromanage that in the way they did with debit cards, they thought would be too hard. Obviously, it turned out to be too hard for debit cards, but they recognized at the time that would be impossible for credit cards. Nevertheless, the politics of it are very good for a lot of politicians. And I think it basically comes down to this, which is that banks, especially large banks, and this has really just been demagogued as going after Wall Street type thing, right? Big banks are, headquartered in New York and San Francisco and places like that, where merchants are all around the country. And so from the perspective of politicians, it's always easy to attack the big banks and to hand things out to merchants. And what merchants have found, of course, is that the big box retailers have gotten huge benefits from this, but the evidence is pretty clear that any benefit to small retailers has been trivial, and many small retailers actually saw higher costs for their card processing fees after the Durbin Amendment went into effect.
Mm-hmm. And why haven't the consumers seen any cost savings, as was promised originally?
Yeah, and I predicted this in my scholarship before it went into effect. And there's a lot of studies on this, which is that what we know is that pretty much all of the revenue losses for financial companies by banks have been passed through to consumers. We've got multiple empirical studies now that find that 60, 70, 80, 90, even 90% of the revenue losses that were suffered by banks as a result of these debit card price controls were passed on to consumers. And what's really vicious about this is it was really passed on most harshly to low-income consumers, which is what banks did originally to try to deal with this. Was the ones that were affected raised the mandatory minimums, monthly fees required to get free checking. So multiple times, I think one study is it went from about $250 a month of an average balance to $1,400 a month, for example. Right now, most middle class people, certainly all the politicians that didn't notice that, but who did? The people who, young people, people who don't have a lot of money, right? Mm-hmm. And then the second thing they did was that after they took away free checking, they doubled the monthly charges roughly for what you would have to pay to have an account at these banks. And so the data that we report and some of our research on this is prior to the Durbin Amendment going into effect, as well as the overdraft rules that also had an effect around that same time, Fed overdraft rules. About 76% of bank accounts in the United States were eligible for free checking. Now it's about 38%. Basically cut in half. Annual fees doubled. I'm sorry, monthly maintenance fees doubled, and the amount necessary in order to have free checking increased substantially. And so that really hammered low-income people, and it's created a barrier for young people to actually get bank accounts in the first place. On the other side of the equation, what you see is that very little of this, there was a study by the Fed, another study of gas stations by Muka Harloff and Sarin, and what they find is if 60 or 70% of the cost of banks got passed on, 10 or 20% at most got passed on by retailers, and that depended a lot on the industry, the market, that sort of thing. The Fed study found maybe somewhere around the same thing, and the dynamics are pretty straightforward, which is large chunks of revenue losses tend to get passed on, which is what banks that get a big lump sum loss, where these little trivial sort of savings on each potential transactions that merchants had tend not to get, this is a general rule of economics, tend not to get passed on. And the second is the market for financial services is just more competitive generally than it is for retailers. And so people just don't shop, they just shop differently from when they go and open a bank account and the like.
Yeah, but for, products and services, including, credit, I mean, margins are pretty tight. And so from a business perspective, I mean, you may not really have much of an option aside from passing on some of these fees. And now, what we've seen, like you pointed out, in, the big bank industry, or, part of that sector of the financial services industry, is that fees have increased.
Yep.
And you've got, a lot more reliance on overdraft. We've got the CFPB looking into fees, and overdraft fees are included in that sort of junk fee label, which we vehemently disagree with.
Yeah.
We don't think there are junk fees in the financial services industry, but that aside, a lot of credit unions do offer free, checking accounts and other fee-free accounts and services, but it is difficult, especially for smaller institutions. So, now that we see the introduction of the Credit Card Competition Act, what issue is this bill trying to resolve on the credit card side? Do you think it's going to have the intended effect?
Of course not. But to your first point, I think it's worth stressing that point, which is that when it comes to things like this, the big banks, the big money center, too big to fail banks, they can always roll with the punches, right? They've got so many different revenue streams, and it's pretty clear if you look at their business model since Dodd-Frank, which is, I think, one estimate back around the time Dodd-Frank was passed, that anybody with less than $100,000 in assets is a losing account for big banks, right? So the view of big banks now is pretty much pay the fee, don't pay the fee. If you're somebody who doesn't have a lot of money, we don't really need you anyway, right? Where it's like they just don't do that, right? They're basically designed to cater to high wealth, high income people, where they can sell a lot of services, right? They could sell mortgages, they could sell car loans, they could sell home equity loans, but they also sell investment services, and insurance, and all this sort of stuff. Yeah, so you can squeeze a little bit of revenue here. So that it gets rid of the low margin customers for them anyway, and then they just make it up over here. And so that's the same thing that's going to happen with overdraft. But is everybody listening to this knows that's not the model of a credit union, right? That's not the model of a community bank. Much more limited line of products, much more different margins. And so, to the benefit of consumers, credit unions and a lot of community banks have continued to compete by offering service and free checking, right? But every time you start squeezing these revenue lines, it squeezes out those competitive advantages, particularly that competitive advantage of free checking. It makes it more and more difficult to sustain that, and kind of destroys the comparative advantage that they have against the big banks. And so, why are they back at this? Well, the first is, as we all know, credit interchange fees are higher. That's for good reason, right? Which is, you got to deal with the float, you got to deal with the credit risk, right? You got to deal with billing cycles, all those sorts of things. That all costs money, right? And so they're always going to be higher. Credit cards are used for online transactions, which have much higher fraud rates, right? And so card not present transactions. So interchange fees have to be higher to deal with card not present transactions, right? And so there's good reasons why credit card pricing is more complicated, more difficult, and will be higher than it is for debit cards, but merchants just don't want to pay it. number one. Number two, what we did see is that after the Durbin Amendment went into effect, big banks did respond by trying to shift customers away from debit to credit. And they did that pretty successfully, especially with higher income customers, which is they stopped offering rewards on debit cards because of the Durbin Amendment, while they could still offer rewards on credit cards, right? And so there was a shift. And the data is pretty clear on this. The shift was to transactional users, right? People who pay off their bill at the end of every month rather than revolvers, to use basically to push people towards that, to increase credit card usage where they could still get rewards. And so one of the unintended consequences of the Durbin Amendment was to increase use of credit by people. And now, of course, the response to that is, well, rather than fixing the original problem, let's go in and create a new problem by using the same stupid rules on the credit market.
Yeah, and because maybe some lower income individuals have had a difficult time getting access to credit. You see products like buy now pay later loans pop up, and those are largely unregulated. I mean, we know, of course, the CFPB is looking into regulating that space, but those can pose serious consumer risks.
Yeah, and it's not like we have to wonder what's going to happen, right? We have so much evidence from the effect of the Durbin Amendment that it increases bank fees and causes people to lose bank accounts, period, right? Here's the thing that's so absurd about this was every country in the world that has done something like the Durbin Amendment has had exactly the same effect. Where what it does is it increases bank fees for consumers and the like, right? And so you do it to credit cards. I can tell you exactly what's going to happen right now if they succeed in what they want to do with credit cards. The reason they want to extend it to credit cards is to reduce interchange fees, right? And we could talk about the mechanism by which that is done.
Right.
We know what happens after that, which is number one, rewards are going to become less generous or maybe go away. Number two, we're going to see the return of annual fees on credit cards because right now it's interchange fees that allow credit card issuers to be able to cover the cost of non-revolvers. All right, that's how that basically the interchange framework replaced the old annual fee framework. Now, that is a huge boon for consumers, the way credit cards are offered right now. Why is that? First, annual fees are regressive. So just like the Durbin Amendment is regressive and harms lower income people the most, annual fees are regressive. You have to pay a $40 annual fee, whether you have a $2,000 or $20,000 credit limit. That's going to hurt lower income people. The second thing is it's going to stifle competition, which is, I have 4 credit cards in my wallet. The reason is I've got 4 cards with no annual fee. You start imposing an annual fee, and what you're going to end up with, people are going to maybe have 1 credit card. They're going to look to switch cards a lot less frequently. The overall effect on consumers is going to be terrible in terms of reducing choice, increasing cost, and reducing competition. There are certain segments of the industry who benefit from that. And I'll tell you right now, it's not the small credit unions.
Yeah, so it sounds like, this would have the exact opposite effect, of the problem that's trying to solve for, and would in fact reduce competition in the long run. And really, these routing provisions are a backdoor price cap.
That's exactly what they're intended to be. And so basically what's happened now is they've gone back and, as you're saying, the routing provisions, they've revisited the second half of the Durbin Amendment, was this routing requirements. They managed to avoid a lot of the damage from that, the way the Fed kind of bailed out that rule the first time by basically requiring 1 PIN network and 1 signature network, right? But it still, as everybody listening to this knows, it still ended up costing money and driving down rates, especially on signature, is what the evidence indicates. And now they want to extend that, and it's not like they're trying to hide it, right? They're obviously their whole point is to try to reduce interchange fees, to reduce the cost that it costs them to take it. Originally, another reason why they passed on credit the first time around was it was also sort of a transparent money grab by the big retailers at the time who who offer their own credit card. Their own in-house credit card, like the Target Red Card and things like that.
Sure.
Right. So there were all kind of things in the original Durbin Amendment that were very slick, or different laws, but there were things in the air at the time. They're very slick, like involving maximum caps on how much you could charge and that sort of thing. So it wouldn't surprise me if partly what's going on here is the big players wanting to basically steer people to their own credit systems with respect to this. But the overall effect is to try to drive down interchange fees, drive down the cost to take it, and they'll just pocket it just like they did with the Durbin Amendment.
Sure. Wow. And can you talk about the exemption in the bill that's currently set at $100 billion in assets? Only those above that threshold would actually be subject to it. And do you think that this will have a spillover effect? It's not just going to be those institutions above the 100 billion in assets that are actually going to be impacted, but much like with the Durbin Amendment, this will proliferate into the rest of the ecosystem.
That seems to be that's what I would expect, which is to say that that we know the Durbin Amendment was promised as leaving the smaller institutions unscathed. But that was at 10 billion, right? Mm-hmm. But over time, it's just hard, some might say impossible, to maintain this two-tiered system of pricing, right? And so I think over time it'll reduce revenues. I think another big problem I also know that that a lot of smaller institutions partner with larger institutions. Mm-hmm. I don't have good data on that, but to the extent that they're partnering with larger institutions that are covered to offer their credit cards, that will impact it as well. But I think an additional concern is, for me, is about security and the impact on consumers of data security. There's reasons why these networks look the way they do, right? There's a reason why consumers want to use Visa and MasterCard branded cards, for example, and not China Union
known
Pay.
And trusted.
Yeah, right. Exactly. And so, when consumers choose something because they know it and trust it, that's a triumph of competition, not a failure of competition, right? And so the whole idea here seems to be to come up with a scheme to keep consumers from using Visa and MasterCard in particular.
Right, to break up this duopoly.
Yeah, right, exactly. And so what does that mean? That either means like China Union Pay, somebody like that, right? They've got this kind of weird thing about national security, which maybe would cover that. Or some of these other networks, which are perfectly fine networks. I mean, I don't think there's anything insecure about a lot of PIN networks, but a lot of PIN networks that have been wanting to get into this space, right, may have the same level of security as Visa and MasterCard. And there's no reason to think they don't, but there's no reason to assume they do, mm-hmm. because, one of the things we know about Visa and MasterCard and the big ones, and the way this is written, you can have Visa or MasterCard, and the other routing network cannot be whatever the other of those two is, right? So you couldn't have Visa and MasterCard. So the whole idea is to try to route these transactions through different networks. And one of the things that does is it fragments the data ecosystem. And one of the reasons why Visa and MasterCard are so good on security is because they are truly on the cutting edge of artificial intelligence and big data analysis, right, to flag these transactions. The more you fragment payments across multiple different networks, you lose information. By doing that, right? And so that's a cost that I don't think they've really focused on. If you fragment, and that's not even counting whatever inherent limits that these various networks might otherwise have if they have them.
Yeah, that's a really interesting point, and I wonder, how exactly that cost can be quantified. But certainly, no longer having the consolidation of data, I could see that having some negative consequences.
Yeah, and the other thing that is just so brain dead, to put it bluntly, about this is this is a fundamentally different market from the debit card market. Now, if we go back to Durbin, there is no evidence, zero evidence, that there was a competitive failure in the debit card network. Right? There's no reason to think that, certainly no reason to think that that there was some antitrust problem or a lack of competition that led to interchange fees being incorrectly priced in some way. At least intuitively, even though there was no theoretical or empirical basis for it, intuitively there was at least some logic there, which is most consumers carry one debit card. Right? Whatever your primary bank is, that's your debit card. And so the idea would be, all right, well, we'll put two networks on that debit card. That is not how the credit card market works, right? Most consumers, I'm not unusual, have 3 or 4 credit cards, at least, right? And we know the average consumer has 3 or 4 credit cards. Competition doesn't occur at the point of sale, which is how it does with the debit card rating. Competition for consumers is at the state, at the place at which you decide what credit card you're going to have and which one you're going to have in your wallet, right? And so, I know exactly which of my credit cards are offering the 5% additional cashback bonuses in any quarter.
There are other factors that lead you to make decisions as to which credit cards you take out.
That's right. And so the fact that you've got multiple credit cards, you can decide at any time to use one of those credit cards because you've got them with you for online or in person or whatever, as opposed to debit cards. And so what they've done is there's clearly no failure of competition in credit cards for consumers, is the point, which is if consumers have multiple credit cards in their wallet, what's the problem, right? And so what they're doing here is just layering on an additional level of complexity and confusion to make consumers choose again when they pull out their Chase or their whatever credit card. They've got to choose again whether they want Visa or some other network. I mean, what's the point? They've already chosen, if they've got a Visa card and MasterCard in their wallet, they've chosen which one they want to use.
And are consumers really going to understand that choice at the point of sale?
Right. Yeah, it just adds a layer of complexity and confusion to that's completely unnecessary, it seems to me, and potentially harmful in the effect of reducing fees artificially, and as I said, potentially imperiling consumer data security.
And now, you mentioned the Federal Reserve's rule and the on the 2 unaffiliated networks for debit cards, and obviously that rule has been finalized. And one of the issues that came up as we were submitting our comments and working with other trade associations to submit comments is this question of fraud. Do you have any thoughts on the debit card side and what you've seen in the data, if anything?
Yeah, there's a couple interesting things that I think are worth pointing out. One thing that was interesting to me, just about debit generally, is for a long time, one of the arguments that were made was that signature debit isn't a real thing. Right, it was that was something they made up, basically, charge higher interchange fees. Well, one thing I'd always wondered about, and now that turns out to be true, is the latest data indicates that while fraud rates are higher on signature debit than on PIN debit, there's 2 things to know about that. The first is that's because signature debit is accepted in a lot of places where PIN simply isn't. Right, so you can pay online with signature debit and either can't or won't. I mean, I'm not putting my PIN number in
absolutely not
website, right? So the areas in which fraud or misuse tend to be highest are where people use signature for good reasons. The second thing is that the consumers are very wary about entering about things involving their PIN. And what we've discovered is that even though PIN rates are lower, the average loss to a consumer when there's a PIN breach is much, much higher. Why? Because they got your PIN, right? So now they're not just making transactions; they can also go to the ATM and clear out your bank account and that sort of thing. And so I think so the whole sort of debit card fraud thing, I think, is very complicated. And again, this is an area in which there's an arms race going on, as we all know, right? There's an arms race between the good guys and the bad guys. And the mafia is, not doing all the things that they did back in The Godfather. Now the mafia is a bunch of, Russian computer hackers trying to figure out how to steal and misuse all this card information. I think it's marvelous, a miracle how the payments industry has developed anti-fraud type things. I remember what's absurd is just a few years ago, they were actually trying to, if you recall this, I'm sure you might remember that a bunch of regulators, primarily Democratic attorneys general and some people in Congress, wanted to require all cards to have PIN on them, right? When they rolled out chip, they're like, well, that's not enough. We got to have PIN. It's like, could you imagine if we were still living in a world where you had to enter a PIN because somebody thought at the time that would make sense, right? We
And
moved
every
away
transaction,
from that,
right?
and now we're
That's
moving away
nonsense.
we're moving towards contactless payments, which are even
Right.
these encrypted contactless payments, which are brilliant in terms of the speed and the efficiency. I mean, this is such an innovative market, and as I say, nobody goes to the grocery store to experience the checkout experience, right?
That's right. That's the worst part
The
of it.
merchants, the consumers, and the financial institutions all want things to be smooth, fast, seamless, and secure. And we have a lot of incentives. There's a lot of incentives in place for that to happen. And pretty much all laws like this do is gum that up.
Yeah.
Right. And just create stickiness, all because some powerful special interest groups think they can make some money off of it. And consumers just won't know what hit them.
Yeah, another frustration with the Fed's rule is the short implementation period, and so our members are going to have to figure this out pretty quickly, and it's going to be a sizable one-time cost to reissue cards. So that is a bit frustrating.
Right. Right. No, it is. That is a cost. And I don't know. I guess these guys in Washington think that just these things fall out of the sky and nobody has to pay for them. So
Yeah, if only. So, in your opinion, what's the best way to promote a healthy, competitive credit card market?
yeah, that's a great question. And I think I worked at the Federal Trade Commission, and as you said, I worked at CFPB. I've studied this from all different angles. And, the first question regulators should always ask is there a market failure here? Is there a competition or consumer protection problem here that needs to be solved? And if so, do we have a solution that'll work and for which the benefits will exceed the costs? This is a particularly frustrating area to work on because there's no competition failure here, even though they keep saying that, right? And in the models, I wrote a paper way back in 2011 when this was first heating up around that time. It may have even been before that, where I kind of went through all this different regulatory stuff. I guess it was 2009 actually, to try to figure out how all these markets work. And what's fascinating about cards is it's an example of what is called a two-sided market. And the Supreme Court actually, you may recall, had a case a few years ago, Amex versus Ohio, where they talked about the antitrust implications of a two-sided market. And what's fascinating about two-sided markets is the platform exists to bring together two sides of the platform to sync up with each other. So the classic example is a newspaper, right? People think a newspaper is there to deliver news. No. That's one of the ways they do it. But what a newspaper actually does is links advertisers with consumers, right? And they do that by providing news that consumers find interesting,
Yep.
right? And so what we see in that is all kind of cross subsidies, right? Which is that consumers pay less than the marginal cost of producing a newspaper because the advertisers
You've got that
subsidize,
revenue coming in.
the consumers. And what we've seen over time is advertising revenues fallen, the price of a newspaper has gone up to consumers because they've gotten rid of the subsidies. A search engine is an example of a two-sided market. I can do unlimited searches all day in my office on Google, right? That doesn't mean Google is free. That just means the advertisers subsidize me doing it. And the advertisers are happy to subsidice me doing it because more searches means more likelihood that I'm going to find it and click on the ad.
And it's a very efficient model because they can, gather all that data and use targeted advertising. Exactly what you're looking for.
And so we get free services, right? And so we see these in a lot of markets, these platforms. And payments is an example of this. And we've come to understand this. And what we know about this is two-sided markets are really complicated. That's the first thing. That trying to apply and study these two-sided markets where you've got these interaction effects between the two sides of the market is really hard. Second, the pricing can be very complicated. So it's not uncommon to have zero or even negative prices on one side of the market, subsidized by the other side of the market. But as long as both sides of the market are both winning, right, both make out better, then everybody's happy. And that's clearly the case with credit cards, which is merchants complain about how much they pay, but why do they take credit cards? The reason is because it's still a heck of a lot less expensive than running their own in-house credit operation, right? And it's that simple. Prior to ubiquitous acceptance of Visa, MasterCard, and the like, every department store had to run their own credit system, which meant billing. And particularly what they didn't like was collections, right? Where you're trying to get somebody to shop at your store, and at the same time, you're threatening to sue them because they won't pay up. And so credit card networks are more efficient. They relieve that problem of collections. The merchants get paid immediately. They just don't want to pay for it. Is simply what it comes down to, and they clearly get more. They get more from this than they pay, or they wouldn't do it. And they could always change their mind and open their own in-house credit operation if they didn't like it, right?
Sure.
And the fact that they don't shows, I think, that they're getting a benefit from it. And so that's the long-winded way of what should we do about competition? Nothing. That. This is an incredibly competitive market. It's an incredibly innovative, competitive market, and there is no obvious market failure that I can see here that requires anything except leaving it alone to allow everybody to sort it out.
Excellent. Well, any last or parting thoughts before we close out our episode here?
Yeah, and I think the thing for listeners when they're communicating with elected representatives and that sort of thing, I think it's really important to make the point that this will harm consumers. Right. This will harm consumers. We know that from the Durbin Amendment, but also to make the point that this also harms small banks and credit unions. By harming small banks and credit unions, you are just benefiting the large banks, right? The whole point of Dodd-Frank, this is one of the bitter ironies of all this. The whole point of Dodd-Frank was to get rid of too big to fail, right? To get rid of the power of the big banks. I've traveled the country for the 10 plus years of Dodd-Frank and polled thousands of people at lectures, like literally thousands, like probably 5,000 people. I have yet to find a single person who thinks that Dodd-Frank got rid of too big to fail, right? And that includes congressional staffers, that includes members of Congress, that includes members of the executive branch, right? Tim Geithner, Jeb Hensarling, and Elizabeth Warren all agree that Dodd-Frank didn't get rid of too big to fail, right? What did Dodd-Frank do? Dodd-Frank has promoted consolidation in every single financial services industry because of the regulatory costs and everything else.
100%.
And this is just more in that direction of further entrenching the power, further consolidating the industry, and further hampering these small competitors who provide such an important choice for consumers. It's a different business model. They serve markets that the big banks don't serve. They serve consumers that the big banks don't serve, such as credit unions. And I just think that message needs to be heard. That central planning and claiming, well, you guys won't be affected by this because of this particular thing. There's just no reason to believe that's true, but based on experience. And I think that message needs to continue to be amplified if we want to keep a vibrant and robust, competitive consumer financial system that gives consumers a variety of choices and doesn't kind of push them all into one-size-fits-all business models that a lot of people don't like and don't need and don't want.
Yeah. That's an excellent point. I mean, we've certainly seen it in the credit union industry. Since the passage of Dodd-Frank, there has been immense consolidation. The industry has shrunk in half, essentially. And so that's a staggering figure, and that's not just unique to the credit union industry. And consumers certainly are likely to face higher costs overall and reduced options for products and services with this sort of legislation. So we've been actively advocating against it.
Yes.
Well, thank you so much, Todd, for your time today. And that does it for today's episode of The CUPP. If you enjoy watching The CUPP, please subscribe, hit the like button, or turn your alert notifications on so you get notified of new episode releases. And leave us a review. Tell us how we are doing, and we're open to any suggestions for future episodes. And with that, thanks again, Todd, and until next time.